All right, we got a really exciting stream for you guys. So much has happened with this space. Banking is not only necessary, it's what's going to take us to the next level here as far as crypto is concerned. And I have no one other than the legends of the space that I want to make sure you guys not only get a quick intro to, but also tell you how they are going to just change everything around. I want to keep this short, brief, but exciting at the same time. So, Tristan, let me bring you on. And why don't you go ahead, start with the intro, and pass it off to the next person? I know we're going to have somebody else joining us here. Oh, Zach is already in the background, so I'm going to head into the stage as well. All right, Tristan, kick us off.
Happy to kick off. Hi, guys. I'm Tristan Dickinson. I'm the CMO of Vaulta Network. Very excited to be here today and yeah, try and shed some light on the rebrand, try and explain a little bit about what we're doing and try and highlight why we're so excited about the direction that we're taking, but also Web3 banking. Then I'll pass on to Yves.
All right. Thank you, Tristan. My name is Yves Larose. I'm the founder of Vaulta Foundation, Vaulta Network. I've been in this space for a little over 15 years now. I've been in Vaulta specifically for 7 years, basically from the beginning to the current transition, and really excited to talk about what our transition is all about and where we're going today. And I'll pass it over to Zach, my co-founder.
So I noticed neither of you guys mentioned the current name, even though we're live streaming. So I'm Zach. I'm the CCO co-founder of what was previously called the EOS Network Foundation, now the Vaulta Foundation, the Vaulta Project. Since we are in a transitory phase, so last week we announced the new branding, but we are currently in the process of basically going through that rebranding process. So that's why if you're watching this today, you're watching it on the EOS Network Twitter and YouTube channel, but if you watch it a month from now, all of those channels, or even in a week from now, all of those channels will become Vaulta. So I just want to point that out in case you're confused. But yeah, co-founded the foundation with Yves back in 2021. Been basically heads down going in this Web3 banking direction since then. And with the rebrand announcement and then the upcoming token swap happening next month, it'll kind of be the final steps of essentially a rebranding process that began almost 4 years ago.
All right, you got to break that down for me. What do you mean it started 4 years ago? This just wasn't like you woke up, rolled out of bed, and went, you know what? Let's come up with a new name.
Yeah, no. So I mean, yeah, I mean, depends who you ask. But no, we started. So when the foundation was created 4 years ago, Zach and I started off with nothing. We didn't have any IP, we didn't have any socials, we didn't own the GitHub repo where the software stack was based. And so from the beginning, we actually had to start a rebrand. We had to change the name of the software stack. We rebranded that to Antelope a couple of years ago. We needed to create all our own socials, Telegram accounts, etc. Trademarks and the likes. And so the rebrand effectively really began, 3.5 years ago. But the idea was we always looked at the rebrand in a spectrum. Whereby, on the very low end, we would do the changes as I just mentioned, and on the very high end of that spectrum, on the other end of the spectrum, name change, token ticker change, etc. And that's essentially where we are now. But that process has taken 3.5 years basically to get here.
Okay, so beyond just the name change, you guys are also focusing in new areas of development in this space. What does that look like?
Yeah, so I mean, in terms of the focus, what we were looking at is who are we? Where do we come from? What have we actually been building towards? And so when you look at the feature stacks, the functions that Vaulta has, they're really geared towards that open finance, Web3 banking solution environment. And so all of the functions, features that we've added over the years, the security, the reliability of the network, and kind of the product stack that we have, let alone when you look at our portfolio companies from the ventures arm, what we've been investing in, and kind of the space that we're able to unlock with that and the different licenses that we indirectly have, etc. Everything was in that Web3 banking space, paired with, in large part, what's been happening outside of Vaulta. Right. So when we look at the broader blockchain ecosystem, especially in the last, I'd say, year and a half or two, we've seen a significant shift towards reprioritizing Bitcoin in terms of where the development was lying, Bitcoin scaling solutions and the likes. And then with the Bitcoin ETF being approved last January, you've got a very different profile of investor or of stakeholder that's now in the market. The capital itself that's in this broader ecosystem is also very different than it was before. And it's kind of that alignment between what we've been working on, who we're all about, where we're going, and where the opportunity lies outside of us as well. And that's where we get that Web3 banking, Rebrand, Vaulta, all of that good stuff.
Okay, I gotta ask, why do you feel that Web3 banking is, I guess, I don't even know if you call it next frontier, but really needed for this space to grow?
I'll give it to somebody else to answer.
I mean,
Otherwise, I can answer all these questions.
we didn't really decide this. I think the market has decided it. We've seen the institutional kind of adoption and welcoming of the blockchain industry. We saw starting with even before the Bitcoin ETFs, let's say, but now with the Bitcoin ETFs, it's front and center. Different regulatory changes, it's been accelerated, especially just in the last couple of months with the new administration. So we're seeing banking laws change, for example. We're in the United States, for example, very recently, the banks have been approved to custody tokenized assets and cryptocurrencies. That was never possible before. The government's the new administration's in the process of a regulatory framework for tokens in general. And that's something that the industry has been begging for a very long time, is just tell us what the rules are. We will follow the rules. We just need to know what the rules are. Whereas like the previous administration, or let's say the SEC, it was kind of regulation by enforcement. So the banks are embracing it because they're allowed to. They were not allowed to before. So even if they wanted to, and some of them didn't, but some of them have turned a corner. So you go back to 2017, Jamie Dimon was calling Bitcoin a scam. And now Jamie Dimon is still a little bit skeptical, but his company at least is embracing cryptocurrencies and Bitcoin. What else? All of the different banks, I mean, they're all running different experimental programs and pilot programs with different blockchain technologies. We have a banking advisory board now. We can get into that a bit later, but getting actual feedback from the banking industry, from people within some of the largest banks in Canada, for example. And we have even, I guess, unofficial advisors outside of the ones that are official advisors, just being at the crypto conferences. It's not us that are making this decision that the industry is heading towards a more, I don't know what we'd want to call it. You could call it a little bit more corporate, but it's really just, it's not that it's changed. Everything's still operating in a decentralized way, but there needs to be a bridge that bridges this decentralized world that we've been living in for the last, 16 years, 15 years that Bitcoin and crypto has been around, and embracing it to connect the traditional financial world with the decentral world that we've been living in for the last 15 years.
No, I love that. And to be fair, like,
I might just add to one point as well. I think when it comes to Web3 and banking, I think banking goes on, or global markets in a generality terms, it goes through major evolutions or revolutions, right? You can think about the creation of the stock market, the tulip crash, you fast forward then to the latest one in terms of how the internet really revolutionized banking. And, none of us could imagine a banking experience now not involving the internet. And it really kind of took this approach, which was not really experience first, in the sense that you had to go into, a bank and you had to talk to them about different things. And then all of a sudden you can transfer money between each other with a few clicks of a button. Maybe for a home loan, you still go into a bank, sure. But humans really evolve based on experience. Some of the best companies or largest companies in the world provide the best experience and the most streamlined experience. So Web3 can be that next evolution, maybe not as transformational as the internet, but it really has the opportunity to improve experience significantly. And if, think about cross-border transfers as an example. Sometimes if you send on a Friday, maybe you send on a Friday night, you kind of missed the banking day, it might arrive, on a Monday. If you think about what blockchain could do, that could arrive in a second, maybe it doesn't, maybe it arrives in 4 minutes. That's still incredibly fast compared to the current, climate that you see. So Web3 is penetrating banking, whether that's products or infrastructure, which improves experience. But I think that's also a major reason. Banking is ripe for evolution, not revolution, but evolution. And I think Web3 really is at the forefront of, based off also what Zach said in terms of, the global climate is becoming more positive. Whether Trump is good or bad doesn't matter, but he has opened the way, or provided a framework with which banks now, which are typically risk averse, can turn around and say, okay, I do want to understand more about digital assets, whether they go infrastructure or product. It's a good question, but it's a very lucrative industry. It is ripe for change. Web3 is already integrated significantly in the industry. If you think about apps like Revolut, so this was very natural. And then also off the back of what Eve mentioned, not anyone can have a tech stack that's suited towards what banking needs. Part of one of the reasons why we're able to become a banking OS is because of reliability. That's stage one. To open the door and becoming an operating system for a bank, you have to be reliable, and the network hasn't gone down in 6+ years. Then you have to be customizable and provide banks with options. They need control, right? And neobanks might be a little bit more risk averse than maybe major banks, but permissionless decentralized infrastructure is familiar for us, and that's great, and we have that. But maybe someone wants a permission set. And so, Web3 is really improving the experience of banking. And it's a very fast growing industry to an extent. And I think Revolut is something that I look at consistently in terms of, it's not so much the infrastructure side of things, more the product side of things, but they've got 50 million global customers. And a significant portion of why that is based on experience, but also based on the offering that they can provide.
All right, give me a little bit of insight as far as how people are engaging with, capital and assets, because I feel like it has been changing, especially with, the explosion of Web3 and the access that it provides. It's almost like Web3 is not necessarily just adding a new layer to finance. It is a new layer, right? It's almost redefining it. What have you seen as far as some of the shifts of how people are, leveraging their capital and assets in this space?
True asset ownership. Tristan was saying that maybe it's improving upon the current financial system. I think it's actually bringing us back to the roots of what people actually wanted in the first place, was to be able to own their assets, to be in total control of your assets, but in a safe and secure manner. And the best option to do that was not keep your funds under your mattress, was to put that in a brick and mortar bank where, there would be guards on the outside, and you've got kind of this castle and this moat, and you've got archers on the side, and they're protecting your funds. That's what we've evolved to. And now we're kind of swinging back the pendulum towards, I can control my own assets. I can leverage my own assets, less middlemen along the way. I can keep more of what I have. I can generate bigger yields, bigger interest on those assets because there's less people in between taking a cut, offering services. And I'm able to do that because of that fundamental underlying technology, which is Web3. So I think we're actually seeing a paradigm shift where people are more comfortable in owning their assets. Obviously, in this space, it's still quite challenging to do so. Management of keys is not an easy task. But as the space evolves, we're seeing solutions come about where they're abstracting a lot of that away from users, bringing in insurance components in between, bringing about different functionalities to make it easy so that you can recover your accounts should something happen, etc. You can have multiple parties on a permission set, robust permission set, allowing for recovery of those accounts. But at the end of the day, that you're still the owner of those assets and they're in your possession. And I think we've seen a shift, especially since 2008, obviously, when this started, where people thought they had assets, and in fact, those were just numbers on a spreadsheet that somebody on the other end could easily manipulate, all the way to now owning your own assets, being in fact the sole and true owner of them, having them in your custody. We saw even what happened in Greece, for example, a couple of years ago, when the government was defaulting on loans and they had to shut down. People were trying to retrieve their assets in their banks. They weren't able to do so. And people started realizing, if the funds are not in my possession, I don't actually own them. Somebody else owns them on their ledger, and they give me the right to be able to access them. But they don't always give me the right to access them, nor do they give me the right to access them at any given time fully, even if the bank is not in default, or there's not some kind of upheaval happening or societal issues causing that. And so we're seeing individuals that historically trusted institutions now start distrusting institutions. And so that's kind of what created this space in the first place. But as capital has been maturing in this space, going back kind of to your previous question, why now? What's different? It's because a lot of the capital that started off in this space was more on the libertarian side, more cypherpunks, more people who want to own their own assets. But now it's been quite some time. We have more functions, more features, more products. People are starting to understand this space more. Now we saw that with the latest wave of capital entering, it's now more mature capital. And that capital wants to be able to leverage products and services that they're currently used to, right? They want to leverage the technology, but also have the same functions, features that they currently have, the same products and access. They want their cake, they want to eat it too. And the space is at a point where you can provide that, where it's got the demand that's now knocking on the door, and the tech underlying in the products and the teams working in this space are now capable of supplying that. And so it's just time, basically. It's just we've matured to a certain point where that's what is being asked, that's what people want, and we have the capacities to be able to provide that. And we wanted to be at the forefront of that, being ahead of the curve. And like Tristan said, because we've been up and running for 6.5 years with zero downtime, with zero incidents that have affected the network wide, then we've got that security and we've got that reliability. And mature capital really thrives on that security, that reliability. That's what drives markets. And that's why we're also seeing right now that there's the markets are a little bit shaky, because markets do not like instability. And right now we are seeing instability. So at the same time, that's also driving people towards moving their capital in a blockchain environment, because again, at the end of the day, it belongs to them. We saw that when the war in Ukraine erupted as well, people having to cross borders, not being able to access their assets, but those who had their assets on the ledger were able to relocate very quickly, very efficiently. So there are multiple, I guess, geopolitical events that are leading to this. There's institutions coming into this space, and then there's the tech being mature enough to be able to handle that demand and offer the supply.
Now, you're talking about this, change in crypto as a whole. You're dead on, right? Like when I lost my original keys, I didn't lose keys. I literally lost a file, I lost a hard drive, right? So we've seen this progress that we've made in this space, and it's been phenomenal. Like I really, really do love it. And it's honestly to your benefit, because I can't imagine, anyone out there trying to create a banking operating system and telling people they need to change everything that they do and how they do it to be able to, come into this new space. But you have a very ambitious goal. You're talking about transforming large financial institutions. That doesn't happen overnight. Although the technology is here, things are better. It's a lot easier for them to get integrated. What's the plan? Like, what's the strategy behind getting all of these people onboarded, essentially?
So we've laid out our vision, our roadmap, or at a high level with 4 different pillars. And the idea is, you're right, this is not going to happen overnight. Some of these products, and the way that I guess 2 of you so far I've heard, there's this impression that banks will somehow all integrate Web3. I don't believe that that's necessarily the case. I think that there are some banks that are a little bit more forward-facing in terms of their thinking, and they'll integrate Web3 components within their products and services. So they won't necessarily run on Web3, but they'll have Web3 components in them. Let me give you a concrete example. Right now, if you're going out to get a mortgage, you can collateralize the assets that you have in terms of stocks, bonds, commodities, that kind of thing. The bank will look at that and will determine whether or not you have enough assets to collateralize to offer a loan, in this case, the mortgage. But you can't collateralize your digital assets. And that's one thing I think we're going to start seeing quicker rather than later. And that's a shift that doesn't necessarily integrate Web3 in the bank itself. It's simply collateralizing your Bitcoin, for example. The bank recognizing that you have Bitcoin, that has value, that it is an asset, and that it can't be counted towards your collateral that you're putting up against, let's say, getting a loan. So that's not necessarily the bank now suddenly being on Web3, or the bank somehow integrating in Vaulta. We're just talking about one specific small component that we are seeing that is changing. That's a sign of things to come. But for the rest of the products, yeah, it's a vision that we've laid out, which obviously we'll deploy, and we will work towards that goal over time. Some of the projects and features or functionalities that we are talking about, we already have in pilot stage. Either we've already created MVPs or we're working on MVPs. Think of one of them in the asset management pillar, for example. The first pillar, we've got a partnership with Cefu that we announced a while back, being able to have your assets on-chain under your or under a custodian on-chain through an agreement, but then those assets then being mirrored to a centralized exchange so that you can run further yield earning strategies. Think of let's say a delta neutral quant strategy that can be running off of Mirror X on Binance, but your funds are actually not on Binance. So that because your funds are on chain, they can be earning the protocol level yield, which at EOS right now stands around, or Vaulta right now stands around 17, 18%. But then complementing that with, let's say, delta neutral trading strategy that can add, let's say, another 4 to 8%. And so you're able to compound both products into better yield while still remaining custody over your assets, or at least the assets being on-chain, trackable, transparent.
That's incredible. I mean, yeah, I love myself a little yield. I mean, I'm a miner at heart, right? Like, this is how I got started into Bitcoin. I was mining way back in the day, well over a decade ago. So like knowing that I can actually earn without having to play all the crazy DeFi games and keeping it simple is music to my ears. But something that's
on the other end, though, you know, somebody might have a higher risk profile. And so now I just talked about maybe a lower risk profile. And so when I talk about capital that's entering the market that's also more mature, when you go to your current bank and you've got some capital to place in investment, they'll offer you, let's say, different mutual funds. Depending on your risk profile, you're going to fit out some questionnaires and you're going to get I'm very conservative, average, aggressive, very aggressive, for example. The one I just mentioned with delta neutral trading strategies, that's one of them, for example, that we are piloting that we'd be able to offer, but that's on the very conservative front of things. You just mentioned, for example, you're not into, you know, the crazy volatile DeFi, etc. But some people are, and some people might want to have that risk profile and have a product that's catered to them that maybe is a little bit more aggressive, that has maybe a wider spread in terms of potential return, able to accept perhaps that there's a greater risk, and so a lower return or even maybe a negative return. But these type of products are what traditional industries used to, and we don't really have that right now. And this is what's being created. So and that's the path that we're on, is to really try to replicate as much as possible what currently exists in the traditional banking, traditional finance sector in terms of product stacks, and mirror that in a Web3 realm, either by building the bridges and the connections to make it happen by leveraging both of them in a CDFI fashion, or porting everything on chain so that your digital assets can benefit from the same type of product that you would originally have in a traditional finance space. So it's not all on chain, not all off chain. It's trying to create products or solutions that can leverage both of them depending on the use case.
Now, when it comes to the keys, the identity aspects of things, I think that's a big play, like a big thing that people have been asking about recently. What are you guys doing as far as the identity management aspect of things? Is that something that's built into your system?
Do I take this question? Anybody can take this. All right, I'll take this question. So Vaulta has at its base an extremely robust permission set. And so I think it was Tristan that touched upon it, or maybe Zach earlier talked about being able to essentially create permission sets or walled gardens, because some institutions prefer to have a walled garden essentially. So think about, Vaulta is an open source permissionless banking OS, or just an underlying piece of infrastructure, an operating system, and people will be able to interact with it in a permissionless fashion, a permissionless matter. But think that perhaps there's a large bank that wants to offer products or services on Vaulta, but they need to go through a particular regulatory framework in order to control who can get access to that. And this is where then the decentralized entity comes in, and at the base of that is that robust permission set. So on Vaulta, you're able to create permission gardens where your essentially restricting who can interact within kind of that sub part of the chain, that product or service. You could do so in multiple ways by assigning, for example, what was known as a soul-bound NFT to a particular account. So let's say I, as a user, go and do AML KYC in the particular jurisdiction that I'm in because I want to engage with a product that a bank in my Canadian jurisdiction is offering. I might go through an AML KYC process, get a token that's only bound to me that I cannot transfer. It's a non-transferable token. And then being able to, with that token, then enter that walled garden that particular bank offers or that particular product offers to be able to engage with the services, respective services within that walled garden. And so we've got multiple different ways of approaching this. But like I mentioned, there's a decentralized identity aspect to this, and there's a potentially a soul-bound NFT type of token that's involved in this. Currently, when you're interacting with your banking services, or even when you're interacting with your governmental services, here in Canada, we use your social insurance number, your SIN number. Well, that SIN number could effectively be tokenized, whereby if you have that, it enables you to do X type of thing. So I know I was talking to some government officials just late last night about writing a white paper that's going to be published and made available, because in Canada, we are currently going through a federal election. And the idea is to offer something to all political parties in terms of, in their first 100 days in government, what should they be on the lookout for? What should they address in our particular field? And that was one of the ideas that we toyed around with, is how could potentially government offer a token that enables you to interact with government services, think paying your taxes or getting access to grants, etc., that's only available to you, and that you're able to interact with the government in a more efficient manner, where perhaps the transactions live on chain, they are seen on chain. The content of those transactions don't need to be seen on chain, that can live off chain, but you get a better reassurance that the government is in fact, interacting with you. You're able to move funds back and forth, or whatever the service may be. But you'd also be able to see, for example, if the government is transacting with other different whether they be citizens, people, or actual businesses, and everything would be represented on chain. So the data itself is currently public in terms of government services, what happens, etc. But you don't have that auditing trail. You always need to trust. In this way, you'd be able to trust but verify. And so that kind of simple solution that involves identity, that involves government, that involves banking solution, that's the kind of thing that we can envision with something like Vaulta.
You're getting everybody to get orange pill here, telling them to not trust but verify. I love that. Finally getting the things that we care about most into the regular world, the normie world, I guess you can say. You did mention Safu as one of the things that you're kind of working on. Does that fit into the solutions to basically bridge, these institutions into the Web3 world without having to essentially overhaul everything that they've experienced, like from day one? Is that part of that strategy?
Yeah, I mean, Ceph is just one example, and that's, I guess, somewhat of the official custodian of Binance. But look at the official custodian of OKX, Standard Chartered, regular company. And that's another partner that we're exploring working with, and that maybe addresses more a little bit your question, because Ceph is really on chain, whereas Standard Chartered is kind of that more traditional partner. And so you can have those custodians, and we're seeing more and more custodians come about. So it's not just these Web3 custodians. We're seeing regular banks or regular custodians raising their hands, saying, I would like to have a piece of the pie. I'd like to pay a part in this future, where yes, in fact, you're able to kind of reduce that friction. You're able to bridge both worlds, where traditional custodians, in this case a bank or a Standard Chartered, are able to custody assets on-chain or digital assets, while also offering off-chain non-digital asset type of product, or linking both, right? Stable coins have a huge part to play in this, and that's another one that we can touch on later.
Love it. Now, you did mention...
I was going to say, he's been talking a lot. I've been waiting for an opportunity to jump in. He's got all the knowledge, but to build on the Safu, I think you mentioned if that partnership would help bring in institutions, but I see it from the other standpoint of it democratizes access for more retail investors to have access to things and tools that traditionally only institutions or large fund managers did have access to. So one of the use cases that's been presented, I think it was presented in the initial CEFU announcement, was, so there's different, we call them delta neutral trading strategies. There's probably more risky ones too, but we're focused on the delta neutral trading strategies, which is basically a risk-free arbitrage that could be done, where if you have a lot of capital, we're talking like tens of millions of dollars, most likely, or even more in a lot of cases, then you could generate yield from your assets. You're just holding your asset, and professional quant traders are doing things with your assets in the most risk-free way possible to generate yield. Typically, that wouldn't be available to you or me, most likely. But with tools that we could build, we call it CDeFi. So that's centralized DeFi, like centralization DeFi. So kind of bridging the financial worlds is, how about if we could democratize access to these delta neutral trading strategies so that regular retail users could access them? But then there's regulation. That's the centralized finance aspect of it. And then going back to, you mentioned digital identity or KYC. So to participate in this, because you are indirectly interfacing with a regulated product with professional quants and arbitrage going on, anyone who would want to participate in that, it might be different for DeFi, but you would most likely, or you will have to KYC. So there will be an identity component if you want to participate in this yield that is typically only accessible to fund managers with millions or tens of millions or hundreds of millions of dollars. So I see it as the opposite of what you said. It's not that you're wrong in assuming you bring in more institutions because they want to use institutional tools also. But I see a big opportunity because most users on any blockchain or even DeFi, most people aren't whales. Most people are probably investing a couple thousand, tens of thousands, some people even a couple $100, and that's a lot of money to them. And right now, the best ways for them to make money is they basically trade on their own, and a lot of times they probably get wrecked. So I'm sure that if they could get a stable, risk-free yield, that they would jump at that opportunity. So that's one of the products that we've kind of laid out the vision for, and that's something that we'll probably be releasing more information on as it's coming closer and closer to fruition. But that is the general idea, is basically democratizing access to these quant traders, not directly, but through the yield that they are already generating for large funds, making that accessible to anybody.
So now losing the ethos of what we really want to see in this decentralized world, while still providing new tools for people to, participate in it all, which is super exciting. But something I did not understand was the Banking Advisory Council. What is it? What's its intent? What does it do? How does it function? Can one of you guys break that down?
I can break that down, definitely. So if you think about entering into the banking space, it's not something that you can kind of just jump into and all of a sudden you can gain market share. You have the connections, you understand from a strategic point of view how to approach certain conversations, you understand from a regulation, from a security point of view. There are a lot of different elements to banking. It's extremely diverse and it's extremely complex in many ways. It's simple in others, but complex in many ways. So really what we wanted to do as a network was to create a banking advisory council. So we call it the Vaulta Banking Advisory Council, and get notable thought leaders, but also really experts in the space to help guide the network on a bunch of different initiatives, whether that's from a growth point of view, whether that's from an understanding or learning point of view, whether that turns into something from an integration point of view, integrating blockchain technology with banking technology. It's not that easy to do. Maybe that's not the right path forward. Maybe in some jurisdictions, it's more about offering, financial services or different products. But then you have to understand what the regulatory challenges might be. So it was really important for us actually to get this council together. And it is made up of some very notable thought leaders. So Lawrence Strong, he's the CEO of Systemic Trust. He's been in the industry for quite a long time. He was the ex-CEO of Binance Canada. I think he was also a regulator as well, but brings a lot of experience to the table, but also a lot of understanding of our space. Didier Lavelle, I'm not saying his name right. I think he says his name better.
You're butchering it.
Yeah, Didier. Anyway, I won't say it.
Didier Lavelle.
But again, there we go. You can tell that I'm good at French.
Do you need that one again?
It's Didier Lavelle.
Z Lavelle.
Didier. Yeah, never mind. Yeah, that was a hard one to say. You don't have that French accent. No worries.
I'll keep saying Didier, but yes, I mean he's the CEO of Tetra Trust, and he's worked with compliance and custody solutions and different institutional clients, and He held senior roles at RBC from an investor and capital markets point of view. So he brings a lot of experience to the table. Alexander Nelson is the Senior Director of Digital Finance for ATB Financial, which is one of the larger public banks in North America. And obviously brings a lot of experience, currently working in banking, has a very good understanding of the industry and a lot of strategic insight that he can build and bring towards the network. And then Jonathan Rizzo, he's a Senior Business Solution Specialist, also works for ATB Financial, and similar in the sense of, a solution specialist. We're working with technology and products, and together these banking advisors, and we also plan to expand the Banking Advisory Council. They really help us to better understand the ecosystem that we're moving into, to better understand from a strategic point of view how to go about different elements, from a growth point of view, how to potentially open doors or unlock different possibilities that we wouldn't have been able to understand. And they're a really integral part of the network. They're going to be a significant part of success for us. They're a really good springboard to have, and something that we're really, really excited with. And, it's new that the council's been formed, and we'll continue to iterate and build on the council, but it's something that we're very excited to work closely with really senior thought leaders and experts in the space.
So something that a lot of people may not have noticed that don't look at news basically all the time. It's something I kind of have to do for the position that I'm in. You guys were everywhere, literally, like not only Web3 publications, but a lot of financial publications, announced what you guys are up to here. Why do you think the reach has been so broad and so many people are actually interested in what's happening here? Is it because it's new, it's innovative? Like, what's the reason why so many people are actually talking about it?
I mean, I guess we're onto something.
Yeah,
I guess that the time is right, the product is there, and people recognize that.
I mean, just think, we're talking like banking, just the word banking, well, I guess in third world countries, maybe not everywhere, but most people are familiar. It's something that everyone can kind of relate to, everyone kind of uses, everyone probably has complaints about. There's a much, think about how small of a population is actually like in Web3, not people that have maybe invested in some meme coins or bought something at some point over one of the bull cycles, but people that are like really into Web3 and really follow the Web3 news. Think about how small that segment is, and then think about how large like mainstream is. So like, if you want to focus just on a Web3 niche, like it's very narrow thinking and a very small piece of a global pie. So it's very much strategic. And part of that is just how you handle PR, how you handle outreach, which journalists and editors you're reaching out to, and not just focusing on the CoinDesks and the Cointelegraphs of the world, looking at the Wall Street Journal and the Forbes and larger publications that have a much, much wider reach than CoinDesk or Cointelegraph.
No, that is definitely the right approach if you want to be noticed and known by people out there. But I would go as far as say the people that are quote unquote unbanked, they care about this stuff too, man. Like I've been hearing it,
Totally.
I heard about you guys from people that have no idea that I had a connection with you whatsoever. People that don't speak English, people in third world countries are like, hey, do you know anything about this? Do you know what's going on here? Like, this is an exciting event, not just for the people that are like banking, in regular institutions. We're talking about the debanked here as well. The people that don't have access to it, they're excited about it.
I would say arguably that addresses their concerns, and it's even if anything, as you say, it's even better for them. When we talk about, maybe you and I or the people on this call, we already have, I'm assuming, access to regular banking services. We already likely have a bank account, and we already likely are able to access financial services. And so for us, it's maybe going from a 85% efficiency to an 88% efficiency. But for somebody who doesn't have access to those services, you're bringing about a whole new world to them. And there are certain areas in the world that were always, poised to be able to take advantage of blockchain technologies, and they have to a certain extent since the creation of the space. But I think with Web3 banking, we're going to see an evolution that we just not seen in terms of being able to offer services that currently are either prohibitive because they're just too expensive. I don't want to get ahead of myself because some announcements are being made next week. But there's a significant portion of the world that access right now third parties to be able to transfer capital, and they pay extremely high premiums on this, and they do not have an alternative. And so being able to offer alternatives at a much more efficient, where the settlement is maybe whatever, in our case it's 1 second, that's why we call it instant finality, compared to whatever and we're not talking about T+2+5 when we're talking about settlement and remittances globally, when you're thinking of TransUnion or Money Union, that type of thing. There we're talking about up to 2-3 weeks depending, and maybe at a best case scenario a week. We're talking about bringing that down to a second and bringing the fees down. That can be extremely prohibitive, from maybe one transfer costing $50 to move over, because some of them, they're on two different types of fees. Some of them are flat fixed fee, so that doesn't make sense if you're not sending a lot, and some of them are on percentage fee, and so that doesn't make sense if you are sending a lot. And so with Vaulta, essentially your fees are negligible. And then you're able to transact with stable coins, think USDC, USDT, globally, instantly, transparently, securely, reliably. I mean, it's a whole new world.
Yeah, and like I have experience in that world of like losing money to those third parties, right? Like I'm originally from Brazil. I moved out to the States when I was a teenager, and like having that experience working with like third world countries and just trying to support people there, trying to help people. This is phenomenal. This is like the next evolution that we've all been waiting for. But something I would love for you to go through is those 4 pillars that you mentioned, because I know that your plan, to broaden the reach will kind of, upgrade or evolve with each one of those. If you could, any of you guys, feel free to jump in.
Is this a test for Zach or Tristan? Who wants to take the test? If not, I mean, I wrote the things, so I can definitely lay them out for you.
We've hit on several of them individually. So just the 4 pillars is wealth management, consumer payments, portfolio investment, and insurance. So the wealth management, basically, we talked about CDFI and SEFU and basically different ways to generate yield from your assets. I think we've already hit that one.
And collateralize your assets.
Your assets, be able to borrow against future yields. I believe Eve tweeted something the other day, teasing something out about that. We were just talking about consumer payments and remittances. So I think we already hit on that one. Portfolio investments, RWAs, like you could look at the statistics and the projections for that market and how it's continuously growing. I think everyone's pretty familiar with asset tokenization and RWAs. I don't need to go into a whole lot of detail. Spirit blockchain, if you look on the blog article, that's the logo on there. You could look at their portfolio companies and maybe take some guesses. And then the last one's insurance. And I'm not going to try to attempt to explain this one because Eve's the one that dealt with corporate insurance in the past and has actually dealt with the issues that some of these solutions are actually meant to solve with Blockchain Insurance Inc.
All right, is that
I can't
jump in?
I can't
I'll jump in for a couple of things. So the wealth management component, like Zach mentioned, you're collateralizing assets, you're able to generate extra yield, and that payment solutions, I touched on one with remittance, but when you combine both of them, think of, and Zach basically kind of gave a little hint on that. Think of being able to have your assets locked in, generating a particular yield. That yield, let's say, is stable, and so you're able to project future yield. And then you're able to take out a loan on that future yield to be able to deposit on a credit card that's linked to your digital assets that you can spend when you go to the restaurant or something. That what you're spending is actually it's future yield, right? So you're taking a loan on that. And so because you're spending debt, that is not a taxable event. So obviously it depends on the jurisdiction. There's a lot of work to go in that way, but that's the kind of product that we want to offer there. And that's how you can start to see the blend of different pillars. That third pillar, like Zach mentioned, tokenization of assets. The famous report that came out a couple of years back from BCG, the Boston Consultation Group, projects that by 2030, the RWA space or tokenization space is going to be up to $16 trillion. And we're seeing that grow year over year significantly. Even since that report came out, we've already seen that we're on track to perhaps even beat those projections. And that final one, just to add to what Zach mentioned, historically, whenever you want to work in this space, it's incredibly difficult to get access to traditional financial services. Think of just getting a bank account. So because you're in the crypto space, financial institutions look at this as you're inherently riskier, or you're of an unknown risk because they don't understand what you do. And so by default, it makes them that either they're leaning towards not offering you banking services, or they want a little bit more assurance in terms of, if something happens, will they be made whole, essentially, or will they be absolved of the perceived risk that you bring about. And so that's where the insurance portion comes in. And here we're really talking about real world insurance. So if I'm a developer and I want to create a company and I've gotten grants or something like that in this space, I do need access to financial services. I need to make payroll. I need to pay my bill at the end of the month, whatever it may be. That company perhaps has or a need, and more often than not will have a need to financial services, but you can't get those unless you're insured. And it's very difficult to get insured in this space. Think about directors and officers insurance. Think of, if you're a minor, infrastructure insurance, cyber attack insurance, that there's a slew of insurances that are accessible, but as soon as you check that box, or you label your company as I am associated to blockchain or crypto, you now become a liability. You now, your premiums essentially jump up. So even if you are lucky enough to be able to find a company that will insure you, your premiums are gonna be through the roof. And so think of a company that's not in the Web3 space, and they are doing a very similar product to you, whatever that product may be. They're just not incorporating Web3 inherent functions or features within their product. They're able to get access to insurance at a much lower rate. And that's been the norm now for years. And so it's kind of a chicken and egg. You can't get insured because it's too risky, or you just don't have the funds to be able to pay for the insurance. But because you don't have insurance, you can't get the banking service. And so you can't actually really grow your company, or you can't operate in a compliant manner in some jurisdictions. So often what happens, we see regulatory arbitrage. Teams move overseas, they incorporate overseas, they have to relocate, or they just end up giving up and they just don't join this space. And so innovation is stifled. With that component of insurance, we're closing that gap, where we created a product that's specifically tailored to crypto companies, made by crypto companies who understand the risks in this space, who understand their players in this space, and understand kind of the realities and the challenges, but also understand that that certain things are quite vanilla and there shouldn't be a high cost of that. And so we are launching a product called Blockchain Insurance Inc. That will be able to benefit those companies, offering premiums at a much lower rate than currently is available. And this is because it's essentially the world's first digital assets captive insurance. A captive is regulated by the government. Captives in the insurance world are quite standard. So the rigor in which you need to go through in order to be able to showcase that you're properly capitalized and that you're able to offer these insurance products compared to, let's say, a private insurance that can offer to anybody. And so inherently their risk is a little bit higher. In this case, a captive can only offer to its members or associated members. And so you're able to create associations, memberships that then basically kind of do the filtering in between as an added mechanism to be able to verify whether or not the company or the individual that is trying to be insured meets the standards that are set in place by the insurer. And so long-winded way to say we're closing that gap between being able to offer financial products, because now you'll be able to have insurance at the backbone, and those two play very, very well together.
Wow, I was gonna ask, like, how are you guys supporting the Bitcoin ecosystem here, but this is incredible because that's my life, right? I deal with miners every single day. Like I work with companies that have a handful, 1 megawatt, all the way up to an organization that has over 80,000 miners and mining over 1,000 megawatts right now. So that is a hard thing for us. Finding insurance that actually makes sense is incredibly difficult. But I know exSat plays a part in this whole
good segue, right? Of another way that we're supporting the Bitcoin miners. Yes.
How is that? Can you break that down for us?
All right, somebody else can take it. Go for it.
So I mean, the 2.0 white paper has yet to be published, but there was a blog article that's kind of a sneak peek of what's to come. New tokenomics, new functionality for that. Still working on increasing the synchronizers, which are the mining pools, basically using their.
What is exSat, Zach?
Oh, exSat is a we don't want to call it a layer 2, but it's a Bitcoin scaling protocol. It's leverages a hybrid consensus mechanism. So it's kind of like it's kind of a bridge, let's say, between Vaulta and Bitcoin itself. The infrastructure providers essentially operate infrastructure on both sides. I'll give a concrete example of what we call synchronizers. So synchronizers are Bitcoin miners who mine Bitcoin. They're the most if you don't trust the Bitcoin miners, you probably don't trust Bitcoin. You always hear about the 51%. If you have 51% of the hash power, you basically control the network. So whenever we set out to establish a Bitcoin scaling protocol, how do you establish trust? What's the best way that you could establish trust? Because everyone trusts Bitcoin, but how do you trust the operators or infrastructure of the scaling layer? So the best way to do it was to actually leverage the Bitcoin miners themselves, ideally with more than 50% of the collective hash power. So essentially, when I say that they bridge between the two networks, the miners are already mining Bitcoin, but we want to mirror that UTXO data. So mirror the entire state of Bitcoin and the entire history of Bitcoin into Vaulta RAM, which is a high-speed, decentralized database mechanism with an economy already built around it. It's been live since 2018, well established. So the Bitcoin miners essentially, every time they produce a block, they essentially push, or anyone produces the other miners produce a block, they basically synchronize that UTXO data and push it into RAM. So they're running a piece of software that is writing into Vaulta RAM, and they're already running the mining infrastructure on Bitcoin. And then on top of that, there's another piece of infrastructure we call validators. Those are a lot of large custodians, Bitcoin holders, trusted entities. I believe there's
miners.
40 miners themselves. Yeah. So you could be a miner, you could be a synchronizer and a validator to participate in both. But they're essentially checking the work of the miners. So if you didn't trust 50+% of the hash power already, then there's another group of 40 other infrastructure providers called validators. They basically just check the UTXO data to make sure it's valid and not fraudulent. So that's as trusted of a system as we could possibly come up with. If you have a better idea, please present it.
How does this help miners was the question.
How does it help miners? So
yeah,
why
should his friends care? His friends are miners. Why should his miner friends care?
We're in a different environment whenever the concept of exSat was kind of come to fruition. So this project really started picking up momentum last January. At that time, it was right when the ETFs launched, but before the market really took off. I don't remember where the price was at the time. Let's say between 40 and 60K. I don't remember the price, but things were good until the halvening. So then the halvening happened. Was it April 20th, I believe, was the date, roughly around there. So whenever the halvening happened, half of the revenue of Bitcoin miners was taken away. That's still the case today, but luckily for them, the price has gone up a good bit, even though it's down a little bit now. A year ago, we would love to say that we were 85K. So it's essentially an additional revenue source on top of the Bitcoin mining for the Bitcoin miners. At the time that exSat was initially being, I guess, the idea behind it and the tokenomics behind it and the economy behind it, it was the miners were struggling. A lot of them were not profitable. They were taking on debt to stay afloat, and they were looking for additional revenue streams that didn't add a lot of additional costs. And that's what exSat offers them. To run this extra piece of infrastructure, it doesn't cost much. I don't know the exact infrastructure cost, but
it's a light client. We're talking about peanuts.
Like you're running, it's very, very light. The hard part's the mining power, the hash power. They're already paying that anyway. So basically, what exSat is paying for is it's paying for their trust. It's paying them in exSat tokens for their trust, and the exSat token is wow, I'm blanking on the word of the
fair launch model.
The fair launch model, yeah. So basically how a lot of DeFi products launch, where you start with 0 tokens. The only way to earn that token is to provide some kind of work to the network. In this case, it's the mining. It's synchronizing your UTXO data. So the miners are earning exSat tokens from 0, and then the validators also earn exSat tokens. There's no team. There's no team allocation. There's no treasury. So very much the tokenomics were set in the same way that Bitcoin was launched. The only people who had Bitcoin tokens at the very genesis of the network were those who were participating in the network and mining Bitcoins. exSat launched in the very same way, where no one got free tokens. There was no pre-mine. The only people who currently have who had tokens initially were those who earned them through providing work to the network, whether through validation or through synchronization. I almost said that's who has tokens today. There are secondary markets today, so you could easily hold exSat tokens because you bought them from a secondary market today, or you could actually stake your Bitcoin towards a validator, and then they could share their yield with you as a retail holder also. So there are other ways to get the yield now, but essentially it's a fair launch model. The token, I won't get into the new utilities because that's going to be laid out in the 2.0 white paper. But right now you only have to stake Bitcoin to validate the network. So you have to have at least 100 Bitcoin, which is, the math is a lot easier, $8.5 million whenever we were at $100,000. I can't do the math today at 85K. But essentially, you need to stake exSat tokens on top of that. So to participate as a validator, you have to have both exSat tokens and Bitcoin staked. But that's when the staking goes live, which will be the specific dates for that will be in the white paper. So I'm all over the place on this, but as far as the use case for it is, it acts as an oracle of the Bitcoin network. So I'll give a concrete example of you could trigger a smart contract based on, we're talking about these new things that Vaulta can do and owning your assets while being able to leverage them as collateral, for example, or take out a loan or have a credit for it. So let me give an example of, let's say Eve has a Bitcoin staked in his wallet, and he's saying that I hold this one Bitcoin. You can trust that I hold this one Bitcoin because I gave you my wallet address. I signed the transaction on Bitcoin. I showed that I have the keys to this Bitcoin on the Bitcoin network. But because it's an oracle of the network, if that token were to move from his wallet address, as soon as that happened, that data would be pushed into exSat because it's a UTXO on the Bitcoin network. It gets pushed into the exSat network. So you could essentially think of it like an oracle where if that balance goes below one Bitcoin, then that could trigger some kind of smart contract, whatever that is. If he borrowed against it, he can't touch his asset because he owns it. So it'd have to be something else. So like if he defaulted on a loan, it wouldn't work in that situation because you couldn't actually take his Bitcoin away. You would have to have some other kind of collateral. Other things you could do is you can kind of have a multi-sig on exSat that triggers a transaction on Bitcoin. One of the flaws of Bitcoin, or not flaws, but limitations of Bitcoin is it does have multi-sigs as far as using like sharded keys, but it doesn't allow for dynamic multi-sigs. So that's another use case for it is if you wanted to have a set of keys that can control Bitcoin, but you wanted the key holders to be able to rotate based on, let's say, a consensus, you could actually change in and out who the key holders are based on any rules of a smart contract. You can't currently do that on Bitcoin. If you wanted to change the keys on a Bitcoin multi-sig, it's very difficult because the only way to change the keys is for the current key holders to actually sign the transaction and reach a consensus. So you could actually have almost, depending on how many keys you're trying to kick out of the multi-sig, you might not actually have the consensus to do it. Let's say you need a 5 out of 6 and 2 people are bad actors in your group. You couldn't actually do it. So that's another use case, but pretty much anything where you'd have to look at the Bitcoin, you basically could trigger. So think of it like Chainlink, but specifically for Bitcoin and even more powerful and more trusted than the consensus of Chainlink. Because like I said, it's the Bitcoin miners themselves who are pushing the data, not saying Chainlink's not trusted. It's probably 12 out of 15 oracles pushing the data, all checking each other's homework, but I wouldn't put them on the same level of trust as Bitcoin mining pools. And right now it's about 50% of the Bitcoin mining hash power. The Eastern Bitcoin miners were much quicker to get on board with this because they're in a different regulatory environment than the Western Bitcoin miners. But there's 2 particular very, very large mining pools that have been in communication with us for a while. And as soon as one of those 2 or 2 of those 2 join the network, it should likely be 65-75% of the Bitcoin hash power. So once you have that, it's just like a super majority of the mining pools participating.
Yeah. So on top of that, I mean, you're not asking for somebody to run additional hardware to go out there and like, oh, let's do some type of oracle. Sure, it acts like an oracle, but you're literally getting the same exact data that the Bitcoin network is actually getting because you're working directly with the people that are mining, right?
And yeah, and you could also think of it like you could batch settlements too. So for example, exchanges and arbitragers and market makers, traders, constantly sending Bitcoin across different exchanges from Coinbase to Binance to Kraken. There's all this on-chain movement of Bitcoin just to move an asset from one exchange to another, even though, I mean, that is what it is. So imagine if the exchanges used exSat as their highway for Bitcoin. Because look at the list of custodians who are participating as validators already. They're aware of the exSat product, running the exSat software. Now imagine if they wanted to use almost, this is their own Lightning network, and then they did settlements. Instead of doing a settlement for every single transaction, I send Bitcoin from my Binance account, which I don't have because I can't KYC through it, but my Binance account to Tristan's Coinbase account, let's say, or the other way around, because you could probably use Binance and I could use Coinbase. So instead of that going on chain, I'm just using these as examples. I'm not saying Binance and Coinbase are going to be part of this, but just as an example. Instead of that transaction being seen on chain from me to Tristan, Binance logs it, Coinbase logs it. It's logged as part of a big batch of transactions between those two exchanges or whoever the custodians are behind them. And then let's say once every hour or once every 24 hours, it could be even once every 15 minutes, 10 minutes, whatever they want to do. They just batch all of those transactions and settle what the difference is. Because let's say thousands of transactions transpire between Binance and Kraken or Binance and Coinbase or any two exchanges. At the end of the day, there might only be a balance difference of one Bitcoin, even though thousands of Bitcoins went back and forth. They all kind of just offset each other. If I send one Bitcoin to Tristan's exchange and Tristan sends one Bitcoin to my exchange, we're already settled. We don't even have to do a transaction on chain because it offset. Even if it was different retail users making those sends, the end balance is still zero. You would only need to balance. You'd only need to transact on chain what the difference was whenever this time for settlement is. Did that make sense?
Oh, it totally makes sense. I mean, this is how real banking actually works.
That's
but
exactly yes.
We seem to think that we need to reinvent the wheel every time we add Web3 to things, and like this is what actually makes sense to do. You know, it's way more efficient. To me, we shouldn't be reinventing the wheels. We should stick with things that actually work. Just make it more transparent and easy for new players to come in to our little world and participate in it. But something that we've been getting questions about is in regards to the EOS tokenomics. Is it going to get altered? Are things going to change? What happens with the token? Is EOS staking real? Is that a real thing? Or believe me, we get all sorts of questions, and weirdly enough, I get a bunch of those, even like direct DMs to me. But
none of the tokenomics are changing. So there was a tokenomics upgrade last year. That was the most major change to tokenomics since the network launched. Went from an inflationary model to a fixed supply, which was very important for both function and narrative. Even though when you have an inflation schedule, you're taking tokens that were not in supply, you're minting them and putting them in supply. Whenever you have a vested wallet that drips out tokens at a slow rate, it's the same exact thing. It's tokens that were not in circulation going into circulation. But there's a few key differences. One, just people don't really think that deeply, I don't believe. It's just inflation bad. That goes back to the ethos of Bitcoin in the first place. But then the other thing is being able to calculate FDV, so fully distributed value. If you have an inflationary supply, the supply is technically not capped. It can go up forever, so you can't calculate FDV. Part of the tokenomics changes also included adding funding for things like staking rewards, which you mentioned. All of those changes happened last year. There was no need to go back and try to change tokenomics again. One, because it's something that should only happen very, very, very rarely. If a project's constantly changing their tokenomics, I would say that's not really good for the project or its reputation. The other thing is the supply doesn't change, like the total supply. It's a one-to-one swap. There's no bonuses. There's no special airdrops. I want to just point that out too, is there's no airdrop. If you see any links to anything or any messages on social media promoting any type of airdrop for the Vaulta token, it is 100% scam. The only way to get a Vaulta token is to swap your EOS tokens. So it's a one-to-one. If you have one EOS token, it becomes one Vaulta token. We will have a smart contract. It's already been audited by two different auditing companies, very reputable. We're already coordinating with every major exchange. They are aware of the specific dates. We have not made the specific dates public because mainly just because if any of the largest exchanges had a valid reason to change them, and they wouldn't change them by much, maybe a couple days, then we would basically adjust on our end before making those dates public. Those dates are in May. We do plan to announce the token ticker name, so that has not been made public either. We're just calling it the Vaulta token. We can continue calling it the Vaulta token, but the Vaulta token ticker will not be Vaulta in a 5-letter symbol. I will say that. But that's it's unique. I'll say that. But we're going to announce that in early May, and then the token swap will begin mid-May. Let's say. Let's leave the date pretty flexible, and then we'll also be able to. exSat, we were talking about exSat before. exSat's one of the title sponsors of the Bitcoin Las Vegas conference in Las Vegas in the last week of May. So Vaulta will have both a direct and indirect presence there. It's an exSat representation there, but Eve is obviously a representative of both. He will be on the main stage, so there will be some messaging related to Vaulta there, maybe a potential partnership announced at that time. So Vaulta, we were just talking about exSat and how it's the Bitcoin layer on Vaulta. There will be a presence at the Bitcoin conference, let's say, for Vaulta to introduce it to that audience as well. But to go back to tokenomics, no changes. I don't know how else to say it. There's no changes. It's still a resource.
Really good way to say it. There's no changes.
It buys memory, which is called RAM. It powers up transactions. It's basically the gas token of EOS. Nothing changes. There's no new funding created, which is actually kind of unique, I guess, if we want to go there. There's a lot of projects that have rebranded their tokens and launched new mainnets recently. Every single one of them changed their tokenomics. Concrete examples, Sonic and Polygon both added inflationary mechanisms to their tokens. They're previously not inflationary, now they are with their new network. I believe one or both of them also increased their token supply. Basically created new tokens for an airdrop for a new incentive program, whether it's going to community members or not, it's still new tokens, the higher supply. So it is unique that the tokens and supply and economics did not change with this. And then the other thing that's unique as far as a rebrand of a token or a mainnet is it's the same mainnet. All the other projects that had to do a new token or chose to do a new token, they launched a brand new mainnet, which there's probably good reasons for it on their end. But on our side, the Antelope, the underlying technology that powers Vaulta, it's highly upgradable. Every single year we do 2 major upgrades. One's usually a hard fork. We can change so many different variables on the network with a super majority consensus of the validators that we didn't need to launch a new mainnet to change the protocol token itself. And there's a lot of key benefits to that. You do not lose all of the state history of the network. dApps do not need to redeploy. So just using the Phantom and Sonic example, they had to create an incentive program to pay their existing dApps to migrate to the new blockchain. So it literally costed the network money to ask dApps that already existed and were already deployed to go deploy onto the new chain. I'm sure Polygon did the same thing. I'm sure there's probably other examples I can give. There's nothing wrong with it. It's great for the projects. It's extra capital for them, but it does impact token supply and tokenomics and things like that. So it's very unique that we weren't required. We didn't want to anyway, change tokenomics or even launch a new mainnet.
I don't know. I as a project, I wouldn't have to work. I'm on vacation. You're gonna upgrade? No, I want to stay on vacation. I don't want to have to deal with this. It's way better if you don't have to touch it. In my opinion, at least. I get it that
the history is hard too. Imagine if you're a lending protocol. Imagine if you're Aave, and you have all these open loans on one chain. To migrate your users to the other chain, they got to close their positions and reopen them. It creates a big headache.
It does. It absolutely does. Now, I hate to say this, but we've been going for an hour and 10 minutes. I feel like I can talk to you guys forever, but I want to make sure I'm cognizant of time for everybody else that's listening in. And I got to ask the big question of what's next? Where do we go from here? I know that it's just a start, but what can people look forward to? Obviously, Bitcoin Las Vegas is going to be one of those events to look forward to, but what about the tech? What about the things you're building? What about the implementation and deployment, across the whole network? What's going on? What can people look forward to?
You gave a hint earlier. He said something's happening next week.
There's a lot, actually.
More, but
yeah, there's a lot. So stay tuned for more partnership announcements. Over the coming couple of weeks, we've got also to announce what the token ticker is. Not that that's major news, but we'll pair it with something. We've got a lot of presence at key events. Bitcoin Las Vegas is huge, right? So Nashville was big. You can imagine how much bigger this year could be. Exat has a major sponsor there, and Vaulta is a part of that. And then diligently working in the background from a development point of view to try and work into the 4 pillars that we discussed before, whether that's solutions that we partner with or integrations with different entities, or really building out some of the end solutions. So we spoke about Cefu at length. It's important for us. We spoke about democratizing financial access. That is an element to the network. It's important for us to continue to deliver against that, and continue to work with these entities so that we can provide different options for retail and institutions. But in short, and to summarize, we have a lot coming up. It's incredibly busy for us. There's a lot of partnerships, a lot of events, a lot of integrations, a lot of development, significant amount of development that's going on both within Exat and within Vaulta. And it's the most exciting time to be a part of the network. It's been.
Sorry.
Go for a sec.
No, I talked about Exat. So not only is Exat the title sponsors of one of the title sponsors, there's other ones, also sponsoring the hackathon. So the Bitcoin Las Vegas is hosting a hackathon. It starts virtually and leads all the way up to the Bitcoin conference. Exat has a very large presence there. We will have advisors there, mentors there. We'll be working with the teams there. There's also an Exat track, so basically Exat specific. So depending on what they're building, if they could tie it into Exat, they'll be able to participate in that track. So we'll be following that along the way with updates. Like Tristan said, the goal is to have constant feed of updates, news, announcements, partnerships. Some of them have even been held back. So there, for example, there's one that'll be coming out soon that it could have been out in January, but timing is everything. So you'll see something along with that. It's more of a technical announcement than a partnership. Well, it's a little bit of both, but I don't want to give too much away. There's a constant drip. So just follow us on socials.
All right, that's actually my big closing question is, what are your socials? Where can people find more information about this? Where can they stay connected? Websites and all that good stuff.
See, I told you we're in this weird transitory stage. So I will tell you that if you're watching this live, our current Twitter handle is EOS Network FDN. You're probably watching this on our Twitter account or on our YouTube account. I would guess that within the next week, let's say the next week, that handle will change. I don't want to give it away because there are a few things not completely set up on the new handle, but I will say that the handle of the EOS socials will change. So there will be an account with no followers that is continuing to hold the handle of EOS Network FDN, and then the new Vaulta handle will go live next week. So if you're following us right now, just follow us at EOS Network FDN, and then if you're already following that account, whenever it does switch over to Vaulta, which, like I said, within the next week, you would have already been following Vaulta. So if you were already following EOS, you're going to be following Vaulta. There's over 100,000 followers. So most of the people watching this, surprise, you're following Vaulta. There's really no reason to follow the old legacy accounts at that point. They're basically just going to be redirects in case there's a link on some other website that goes to our old Twitter handle. It's just going to have a pinned post that says, go follow Vaulta instead. So so we're in this weird phase. If you watch this next week,
everything will be.
I can't give the damn handle. It's hard.
EOSnetwork.com is probably going to redirect to a new place or wherever it needs to go, right?
You could probably guess the domain. We're finalizing a few things. There's a redirect set up. If you could figure out the new domain, you'll just point to the current announcement that was made last week. But very soon there will be more of a, let's say, a website there with all of the Vaulta branding and information. It's really just finalizing a few things. We've been moving very fast. If you can imagine, there's a lot of moving parts that you probably aren't even aware of. The exchange coordination has been a huge part of it. The branding process to even come up with the name, the colors, the visuals, and the messaging architecture for Vaulta, all in parallel with all of the exSat work and the Bitcoin Las Vegas. So there's been a lot of different moving parts all moving at once. So it would have been nice to have had everything go live last week on day one, but it might be a week or two later, but it will all be it'll be happening in front of your eyes. So next week is one of the first big switches you'll see. You'll see all the Telegram channels and all the social media channels, including the YouTube channel that you're watching this on. Maybe they're all just going to become Vaulta. EOS, essentially, the token will be alive for a little bit longer, but as far as the EOS network, like all of that will be a thing of the past. The website eosnetwork.com is where you can currently find information to answer that question. But as soon as the new site goes live, that the EOS network site will essentially be frozen in time. It's not going to get taken down. It's still an archive of great information, but it will no longer be updated. You could look at a lot of the other projects that have rebranded. It's very similar. It'll have a nice pop-up. It'll tell you we're now Vaulta, go here. But yeah, you're just asking these questions at a very awkward time where we just announced last week. We're in the process of going live with all of the new links and assets and social medias. We're moving as fast as we can.
No, I mean, this is great. I mean, it shows that you guys actually care about doing this thing the right way. So thank you for the time. Congrats on being able to get that .com domain that I did just fine. You guys did a good job with the naming there. So great job at picking up the right URL there. Yeah, this is super exciting, man. Like I'm definitely gonna stay on top of it just because it matters to me, the people that I'm around, and more importantly, getting this, Web3 world integrated in real banking is a huge deal. This is how we actually get people to care about the stuff. It's people talk about community this, community that. I love how people throw the community, wording around, when in reality, we got to make sure we're getting people from the outside in, not just building from within. That's great that we get to get people to like us, get people to like different projects within this, ecosystem. But ultimately, if we're not welcoming outside in, we're dead in the water, and you guys are making a difference and a huge impact when it comes to that. Getting financial institutions involved, getting these tools in the hands of the people that need it very, very much. So appreciate all the hard work, everything you guys been up to, and this is definitely not the end of the conversation. Like you guys said, there's plenty more, and we'll definitely be able to see you guys around. Anywhere else you're going to be at other than Bitcoin Vegas? That's the only promise. Last question.
Eve will be somewhere next week.
We'll
post pictures, and there'll be videos.
There will be videos next week. Any other conferences you guys are going to be at or anything like that?
Maybe Token 2049 Dubai, potentially, but definitely Bitcoin Las Vegas.
Wonderful. All right. Both of those are going to have some great, combat sports with karate combat. If you're there, I'll get you all pit side. I'll get you all to have a good time. Just to say thank you for all the hard work you guys are doing on this.
Nice. Sounds fun.
Thank you, man. Thank you.
You guys are phenomenal.
Thanks,
thank you so much. Everybody listening, thank you to you for showing up and actually being here, caring enough to hear this information, and hopefully disseminate it out to other people as well, because this is not what's happening now. This is already the future. This is where everything is headed, and these guys are just leading the way. So thank you all for your hard work, and we'll see you next time with another update with what's going on with no longer EOS, but Vaulta. Thank you all so much.
Thanks, guys.
Cheers.